Our mission here is to take complex documents, well, to dissect them, and give you the essential knowledge you need to be well-informed without all the information overload. Today, we're plunging into the financial reports and the annual activity report for Lydia Energy Cloudi. You'll know it by its ticker LYDYE for the first 9 months of 2025.
And this is a lot more than just a standard financial review. We're looking at a company that is fundamentally redefining itself. We're talking massive structural transformation, all while operating in a high inflation environment, which means using Turkey's really complex hyperinflation accounting rules, TMS 29. Our whole goal here is to translate these big movements on the balance sheet and income statement into concrete insights for you, the individual investor.
Absolutely. If you're trying to quickly grasp what corporate restructuring and inflation accounting really mean for a company's bottom line, this deep dive is for you. So just take a quick moment to like this video, subscribe if you haven't, and let's get straight into the story of LYDYE. Okay, let's first get to know the company a little. LYDYE's history is really defined by change. It was originally founded way back in 2009 in Ankara, but under a completely different name, Taze Kuru Gunda. That literally means fresh, dry food. They were in the produce and food space, which is, a far cry from where they are now.
Oh, completely. That original identity is totally gone. After a few steps, they finalized their current name, Lydia Energy Sesh, in September 2024. Their core activity today is energy production, electric and heat from sources like solar, hydrogen, and wind.
And their current physical operations are all in on solar. They run 5 solar power plants, or GES, in Çankırı, Turkey. Together, they have an installed capacity of about 6,290 kilowatt. Now, kW stands for kilowatt peak. It's just a standard unit that tells you the maximum power they can generate under perfect conditions. So their business is selling that regulated electricity. Headquarters are still in Beşiktaş, Istanbul.
Right, but the structural context is what's really critical here. Up until June 2025, LYDYE was basically a holding company. It had 2 100% owned subsidiaries, the old food business, Taze Kuru Net Gouda, and the energy arm, Birinci Energy.
And then came this major strategic move. In June 2025, LYDYE did what they called a simplified procedure merger and just absorbed both subsidiaries completely. Management said the goals were pretty straightforward: achieve structural transformation and cut down on operational load and costs.
And that term, simplified procedure merger, is key. It's an efficient way to just, clean up the whole corporate structure. After the merger, the company stopped consolidated reporting. They just started focusing only on the parent entity. It makes the accounts simpler, sure, but it also strips away a lot of the operational detail.
And the most astonishing detail proving they did reduce that operational load is right there in the activity report. It's the employee count. As of September 30, 2025, LYDYE reported 0 employees. They went from 3 employees at the end of 2024 down to none.
And that number 0, it's not a typo. It really forces a fundamental question about their business model, right? They're operating multiple solar assets and managing this multi-billion lira structure with no formal staff. It's just a really aggressive outsourcing model, or that the assets are just managed by the parent holding company staff who aren't on LYDYE's books. It's a remarkable level of streamlining.
Okay, shifting over to governance. Main shareholder is Lydia Holding A, with 64.89% control. They have a healthy registered capital ceiling of 50 million TL, valid through 2028, which signals potential for future funding. Their paid-in capital right now, though, is just under 1.9 million TL. The board has 5 members, including Chairman Enver Çelik.
And on governance diversity, Dr. Semra Demircioglu is both a board member and the general manager. She's the sole female member, so that gives them a 20% female board ratio.
And get this for a financial contrast. While the operational staff went to 0, compensation for upper management, specifically the board attendance fees, went up a lot. For the 9 months ending in September 2025, exec comp was over 2 million TL. That's up from about 1.2 million TL for the same period in 2024. It really shows you where the money is going.
Right. So let's set the broader stage. LYDYE is in the Turkish renewable energy sector, the dynamic space. The decision to just shed the old food business shows a very clear pure play focus on energy and, I think more importantly, on financial optimization.
So before we dive into the financials, let's frame this with a quick SWOT analysis from the report. What are we seeing as their strengths?
Well, the move to green energy gives them strong market appeal, aligns them with growth. The strong ownership by Lydia Holding provides stability, and they've proven with the merger that they can execute really complex, decisive structural change and do it fast.
And on the weaknesses side,
The reports signal a huge reliance on non-operational income. That means they have less control over their profit streams. The zero personnel thing raises massive questions about the long-term management model for their physical assets. And finally, their growth profit, the income from actually selling electricity, is going down.
okay, what about opportunities?
The opportunities are really tied to the sector. There's just huge potential for growth in Turkish renewables. And that 50 million TL registered capital ceiling gives them untapped funding capacity if they decide they want to raise fresh capital for new projects.
And finally, the threats.
The main threats are financial instability. I mean, this extreme reliance on volatile financial assets for profit, it makes their bottom line a hostage to the stock market, not kilowatt hours. They also face risks from the high inflation adjustments, and critically, their liquidity risk is acute, very low cash reserves. That makes them vulnerable.
Now we can move on to the heart of the reports. And before we analyze any number, we have to repeat this. Every single figure we're about to cite is adjusted for hyperinflation under TMS 29 standards. This means we're comparing apples to apples, but the adjustment is aggressive. The 3-year compound inflation rate was 343% in September 2024 and still 222% in September 2025. These are figures adjusted to the purchasing power of September 2025.
That context is it's essential. So overall, total assets grew by about 28%, from 2.4 billion TL at the end of 2024 to 3.07 billion TL by September 2025. But the real story, the most significant story, is where those assets are held.
Let's unpack this massive asset shift, because this really shows you what management is thinking. Current assets, so the stuff they could sell quickly, like cash or short-term securities, dropped like a rock. From a staggering 1.74 billion TL down to just 44.5 million TL.
And that money didn't just vanish, it migrated. Non-current financial investments, so long-term holdings, skyrocketed from basically zero to 2.41 billion TL. This is the company taking its huge portfolio of stocks and investment funds and just formally reclassifying them.
So if I'm getting this right, they didn't sell their investments, they just moved them from the short-term trading column to the long-term strategic holding column. What does that signal to me as an investor?
It signals commitment. By classifying 2.4 billion TL of financial assets as non-current, management is telling you they are not planning to sell these for short-term cash. They are betting on the long-term value appreciation of this portfolio. It's a formal vote to operate as an investment vehicle over an operational trader.
And on the liability side, things look a lot cleaner after the merger. Current liabilities dropped dramatically from 52.1 million down to just 8.3 million TL. That's mostly because the income tax liability and employee provisions just vanished with the structural change.
Yes, but we need to focus on the long-term liabilities. They are almost entirely one thing: deferred tax liability. And that jumped from 521 million TL to over 715 million TL. This figure is a direct result of that TMS 29 inflation accounting we mentioned.
Okay, why does hyperinflation accounting cause this deferred tax burden to balloon like that?
Because the inflation adjustments revalue assets like their power plants upward on the balance sheets. Their book value goes way up, but the tax authorities haven't recognized that gain yet. The gap between the book value and the tax base creates this temporary difference, and that difference shows up as a massive growing deferred tax liability. It's a heavy future burden tied directly to the accounting rules.
But despite that, shareholders' equity looks healthy. It grew by 28% to 2.35 billion TL. That's a strong capital structure, covering about 76% of total assets. The change in equity includes that 518.3 million TL net profit, but also something called the unwinding of the common control business combination effect.
That sounds like pure jargon, I know. But here's what it means in simple terms. When the parent company merged with its subsidiaries that it already owned 100%, the process of combining the books creates these technical accounting entries. Unwinding that effect is just the action of clearing those internal accounting entries off the books. It's the final step in the structural cleanup.
Let's transition now from what they owned to how they actually performed. This is where we get to the net profit paradox. Looking at the income statement, revenue for the 9 months was 42.8 million TL, which is a noticeable decrease from the 54.3 million they recorded last year.
And the operational performance really suffered. Gross profit fell to 16.6 million TL. Critically, after you account for all the overheads, the company reported an operating loss of 23.7 million TL in the first 9 months of 2025. That loss is significantly worse than the smaller loss they reported in 2024.
Okay, so their core business running solar plants and selling electricity is losing money. and it's losing more money than it was before the big merger. But wait a minute. The company reports a massive net period profit of 518.3 million TL. How is it even possible to lose 23.7 million operationally and still report a profit of half a billion lira?
And that is the main story of this report. The profit is overwhelmingly, almost entirely not operational. You look at the breakdown. 726.1 million TL came from investment income, mainly from stock value appreciation income. Think of it this way. Their solar energy business is like a small coffee shop that's losing money, but their huge savings account invested in the stock market made a massive gain that completely overshadowed the coffee shop's loss.
It also looks like they've gained another 23.5 million TL from net monetary position gains.
Right, that's another accounting gain required by TMS 29. In hyperinflation, if you hold fewer monetary assets like cash than non-monetary assets like property, you get a monetary gain when those non-monetary assets are revalued. It's an accounting boost, but it's not cash from sales. The conclusion is stark. The profit is a paper profit driven by market performance, not by generating energy.
If the operational side is that weak, let's check the cash flow statement for the ultimate reality check. Liquidity.
And the cash flow situation is highly concerning. Cash flow from operating activities turned sharply negative, an outflow of 31.3 million TL. Last year was a positive inflow. This shift is mainly driven by working capital changes related to how those big financial investments are accounted for.
But the number that truly defines the liquidity risk is the ending cash balance. The company's immediate cash and cash equivalents buffer, despite all the assets they have, is just 7,282 TL.
7,282 Turkish lira. That is down from 16.9 million lira at the beginning of the period. For a multi-billion lira company managing energy assets, having less than the cost of a new phone and immediate cash is a massive red flag. It shows an extreme tolerance for liquidity risk, relying heavily on managing cash flows very, very tightly, probably through related parties, instead of keeping a robust cash buffer.
Let's try to synthesize all this. Given that massive net profit, the reported earnings per share, or EPS, is high. It's 274 TL per share. But you have to approach this number with extreme caution, right?
Precisely. EPS is usually a metric of operational health. Here, it is almost entirely a non-cash, non-operational figure. No one is paying out 274 TL per share from this profit because the profit is based on revalued stocks and accounting gains, not money earned from selling electricity. For retail investors, you have to differentiate these investment gains from sustainable operational earnings.
Okay, moving to the footnotes. We know the source of the profit, those financial investments, but how confident can we be in how they're valued?
High confidence, actually. The report confirms these assets are valued using level 1 inputs. That just means the values are based on quoted observable market prices for identical assets. If the stock market says the shares are worth that much, the company can report it as a real gain, even if they haven't sold the stock.
And finally, let's look at this web of related party transactions and guarantees.
The company provided about 4.9 million TL in contingent guarantees, mostly for energy generation and legal matters. But what's much more significant are the guarantees they received. LYDYE got substantial guarantees totaling 40 million TL from related parties, specifically Lydia Holding and Ufuk Yatırım. This is critical. In a moment of ultra-low liquidity, the majority shareholder is providing a substantial financial backstop.
And we also see a short-term debt of about 3.5 million TL owed to Lydia Holding. This network of debt and guarantees really confirms that tight relationship.
And when you look at management's actions, the merger, no subsidiaries, 0 employees, the strategy is one of surgical cost reduction and focused asset management. It's not about aggressive energy expansion in the near term. The financial performance confirms this. For the first 9 months of 2025, the company acted primarily as a massive financial investment holding vehicle. The energy segment is really just the platform that provides the green branding.
That structural dichotomy really defines LYDYE's position, doesn't it? They successfully cleaned up their legal structure to become a pure-play green energy company on paper. Yet their financial health, their profits, their equity, it's all completely reliant on the performance and valuation of financial assets in a volatile market.
So for you, the investor, the fundamental takeaway is this. You have to decide if what you're investing in is a regulated green energy operator or a financial investment fund that just happens to own 5 solar plants. The data suggests you are currently buying exposure to the Turkish equity market dressed in green energy clothes.
A crucial distinction that dramatically changes the risk profile. And that is a wrap on our deep dive into LYDYE's 9M 2025 reports. If this breakdown helped you sort through that complex data and understand the real story behind the numbers, please like the video, subscribe to the Deep Dive for more analysis like this, and share this information with anyone else who needs this kind of shortcut to being well informed. Until next time, keep digging for knowledge.